Well, it's a busy week for investors with Fed Chair Jerome Powell's comments on tap, along with Friday's jobs report. Investors going to be tuning into these economic insights to find out clues on the Fed's path ahead. And Julie, so big week. I think it's going to be about the jobs, but focus is going to be on Powell's comments on Wednesday, the biannual Humphrey-Hawkins testimony instituted in the late 70s during the Volcker era when he was trying to quell inflation. I think those two time periods line up. There might be a little overlap or not. Anyway, the bottom line is I think this testimony is going to be very key to determining if he's happy with the current trajectory of economic data in the U.S. and if he thinks that financial conditions maybe have loosened a little bit, tightened too much, haven't gotten much pushback from him over the last few months on that front, but things could change?
Yeah, things could change. Although if you listen to the recent Fed speak, right, it seemed like they were sort of laying the groundwork and then he's going to come in and sort of
hammer the 50 basis points?
Yeah, I don't know. I don't think 50 basis points necessarily, but I think he's going to just come and confirm what we've been hearing from them. This is likely to be the last commentary we get from him publicly before the March 22nd meeting of the Federal Reserve. And so there's going to be a lot of attention paid. Just looking at some notes that we've gotten this morning in advance of his testimony, Krishna Guha over at Evercore ISI, among them, says, we think the Fed chair will open the door to a calibrated upward move in the estimated peak interest rate in March. If the next batch of data confirm the strength from January. He doesn't think that he'll fuel speculation of a 50 basis point move or turn, in Guha's words, max hawkish. Yeah. So still perhaps a measured tone will be coming from the Fed chair.
Here's what I think happens. I think we have two huge economic data points, which is first NFP, that's non-farm payrolls, this Friday, the big monthly jobs report, then CPI the week after. If those come in hot, I expect some kind of leaked article in the Wall Street Journal.
Nick Timiraos article.
Exactly. I would expect that because that has been the Fed's MO in this rate hiking cycle. So why would they deviate from that? But that is if these reports come out hot. And if they don't, maybe stocks enjoy a little bit of a run up on that. So
maybe, but the recent data that we've gotten has definitely confirmed the heat, right? We got last week some of the ISM readings that showed higher prices paid components, i.e. higher inflation than the Fed might want to see. And if we get the February jobs report that follows in the heels of January, yes, the estimate is for job growth of 215,000 for February. But remember, we got 517,000, which was a blowout report by any measure in January. And so even 215,000, that's still a lot of jobs.
Historically, that is still above trend. Right. And wage growth, that is expected to come in at 0.3%. That comes even in line and maybe a little bit hotter depending on rounding. I think that's going to weigh on stocks. But I'll tell you what, for this matter, for the S&P 500 had a really nice rally in January. We're going to talk about this more, flagged off a little bit. I think it can resume because it's been able to withstand these incrementally bad news reports as they reflect increased Fed hawkishness. So if the market can withstand all of this added extra pressure without the 200-day in the S&P 500 cracking its moving average, I think that's something to be said for the stability of this market right now. But we got some key levels in play.
Yeah, and one more level just quickly to mention as well as that 4% level in the 10-year, right? And not just in the 10-year, but across the curve. It's come below 4% once again. So we'll be watching to see if either the Powell testimony or the jobs report pushes it significantly above that level once again. We'll be watching it.